making over $1 million in payouts and proving it.
Skeptics don't necessarily have the same ceiling of education as other people. Say, for example, I told you I can make $1 million from the markets. The skeptic says, no, you can't. Whereas the person that has an open mind says, I don't know if you can, but I'm gonna try and find out if you can. When I came up, I didn't know anybody that was a profitable trader, so I wanted to find out on my own. And the only way you do that is just by walking the walk.
We've had a lot of ICT traders, we've had a lot of ICT haters on the show. Well, Kyle has made over $1 million in payouts, and he pays tribute to his strategy that is a derivative of ICT concepts.
My goal for really investor standpoint or trader standpoint is to just reduce the emotional volatility in my portfolio. That's obviously when you're gonna start making more mistakes in the market. The best way to reduce the emotional volatility is to it's like a psychological trick. To me, if you know how to trade, it doesn't matter what medium you're using. So if you can do it in a personal account, you should be able to do it in a prop account. Does it really matter if you're trading on real funds or not? Because I guarantee if you give your money to a broker, they might not even be using your real funds in the real life market. So like if I give my money to Oanda, they're probably just gonna B-book me anyway.
Daily cycle one I think is rather easy to grasp, that you can really model them out. The weekly one, I want to hear your thoughts on like the repeatable ones that you've seen are very common, a very typical weekly cycle profile.
Yeah, so this is one that I've been trading for years now, and it's a trade that like I kind of bet the house on. It's a trade where...
Well, ladies and gents, we're back, and this is going to be a big one, I am sure. Last time we had a round one with Kyle, it was with Raja, so they had the whole pro, anti, ICT, SMC kind of vibe. Now we are going to be joined with Kyle on a one-to-one basis so we can have a full exploration on his journey, trading, making $1 million from prop firms, and you know everything that makes Kyle Kyle. So, bro, thank you for running back part two. Excited to have you here, man.
Yeah, man, thanks for having me on.
So yeah, let's kind of do a brief update on since the last pod. Again, it went completely viral, and we talked a lot about SMC, ICT, and kind of deep in those topics. But now we can kind of talk about your journey and life updates as well. So just very briefly, for those of the very few that maybe didn't watch the episode, kind of who you are, how you trade, and what you've done in your trading career.
Yeah, so I've been trading since 2011. I know it's been a very long time. It took me 7 or 8 years before I actually became profitable. And right around that time, I think I was already transitioning to becoming profitable. But then I was able to find prop firms. So FTMO's ads started popping up on my screen right around COVID. And I looked at it like, oh, this is a huge way to leverage my capital. And that's kind of what I look at prop firms. It's a solution to leverage your capital. That's really all it is. And, you know, I kind of just had curiosity because first glance, it's like, oh, this seems kind of scammy. Right, you only have to produce X amount of percent returns in a short, you know, at the time they had a 30-day window where you had to pass. So, you know, I said, why don't I give this a chance? The worst case scenario, I lose my $900, but the opportunity, right, the proposition was that you're going to get paid out. I think at the time it was 70%, which was like on the low end, right? So when we talk about props now, we can get into the rules and everything, but I explored that opportunity. Had taken the knowledge that I had gained over the course of 7-8 years, where I started applying it in that specific prop account. At the time, I was still working. I was working in construction as an estimator, so I was putting budgets together for multi-million-dollar homes. And to me, when my trading really improved was when I just started looking at it as a numbers game and not so much the emotional game that I was so attached to. So when I was able to really treat it like a business was when I was able to start actually seeing real consistency and getting quite large payouts. I wasn't quite ready to leave the job yet. So I kind of had given myself a plan. It was really like a 2-year plan to replace my income, and I didn't want to just make half of what I was making at my job. So let's say I was making 100K. I didn't want to just make 50K and then be comfortable leaving my job. I needed to make more than my salary, so I knew that this was an opportunity that I could actually lean on because I had bills. I was a little bit older. I have a wife at home, adult things. So obviously I needed to put myself in position to succeed and have a safety net going forward to be able to take the risk to go full-time trading. Yep. And then, since I had gotten that FTMO account, got some really big payouts, saw new firms opening up. So then I pretty much took the opportunity, left the job behind, went full-time trading, and then, it's been amazing since.
So I remember shortly after our pod, a couple of months after, you did a mega viral thread. It's your pinned one on Twitter, which is basically like, hey, here's what I've done, and it's a shutdown or a mic drop to the industry, which is, to my recalling, it was like, here's proof I've done $1 million, and then every single certificate, and the thread goes on and on and on. So talk to me through that.
That thread actually has 1 million impressions now. It just crossed 1 million.
Gosh. And remind me, what was the thread itself? Like, what was the amount?
It's like 1.187. Yeah. And
And across how many payouts, how many certificates, how many
I think it
prop
was like
firms?
300 payout certificates, something crazy.
Okay.
Yeah.
And now, fast forward a bit more to present date. Obviously, a lot has changed in the world of props, and even yourself transitioning maybe towards futures, which I've noted, and a lot of the big props that you were leaning on now no longer around. So I kind of want to hear what's your situation and setup in trading right now.
Yeah. So people are messaging me right now and they're asking what my risk parameters are because I'm still doing large payouts, but at smaller firms. And you obviously, as a trader, you have to adapt to what's going on. So after we spoke, all these things started happening, right? Firms started going under. A lot of firms, I lost a lot of capital, essentially. I went from $5 million in funding to now like 1.5. So obviously, if I'm trying to keep up that level of income, I have to risk more. But with that comes a higher risk of ruin. So I have to be more comfortable with losing accounts, right? Basically cycling those accounts. And the more and more I'm trading, I'm finding that more firms are adding rules. The rules are getting tighter. They're getting stricter. They're being more vague with the rules. So they are denying payouts. So you really just have to understand that this is a risk that you're taking when it comes to the prop industry, right? It's a tool to use to leverage your capital, right? You're getting a product or service on the other side of that. You're not getting a guaranteed product or service, though. That product or service could disappear tomorrow. And this is where I think a lot of traders are struggling with, and I see so many people putting their last dollar into some of these firms. They're like, I saved up X amount to pay for this challenge, my last paycheck, essentially. And then they're saying, you guys owe me money. I have to save up my paycheck again to reinvest in this other firm. And in my mind, right, you're not really approaching trading the way you should be.
You know, there's strategies you can have with prop firms. So obviously, majority of traders are stuck in the realm of like one funded account. All the pressure rides on one account, and they got it's their get out of jail ticket, or it's their lottery ticket. Let's say more accurately, it's like all the pressure rides on that first payout, that second payout, and it's a very short term horizon. As someone who's had 300 plus payouts and over $1 million, what kind of approaches and strategies did you have? Because you're not now just using one account. You had at $1.5 million. And was there any strategies on how you manage that many accounts, or any strategies on how you can make the most of that many accounts, knowing that it is prop money, there's a reset button, and cycling in and out of accounts and so forth? What kind of strategy did you have, and has that changed to the present date?
So there's two ways you can approach that. You can trade them all as one large pool of capital, which I did for a long time. I was just copy trading, risking 0.25% across the entire portfolio, I guess you could call it. And I was really only aiming for 2 to 2.5% a month. If on $5 million, now we're talking six figures a month. The other approach is to split up the capital, which probably is a good idea right now, to split up the capital and trade different assets in different time frames, and really treat it like as if you're trading a fund, right? So that way you're diversified across different strategies, different assets. And even right now, I think since we spoke, I was really solely focused on FX. But now that I'm in a position where I want to be more diversified, I want to trade personal accounts, I want to trade pop accounts, I want to trade futures, I'm trading crypto, I'm trading FX, swing trading. So I have multiple strategies, multiple time frames, and just organizing that is way different, and I think easier on the psyche, because if I go and draw down on my one account, right, I have a whole different asset class that I'm trading that could be on a hot streak, right?
So the approach I'm more a proponent of, just to briefly describe, I call it the revolving door. So let's say you have 10 accounts of 100K each. Instead of trading them all at once, which is the kind of logical approach, and then you have 2% gain and you lock in that significant number, rather distribute them out throughout the month. So don't start all at once, rather stagger them. So week on week, you start 1, then 2, then 3, and at one point you'll have all 10, but then you cycle them out. So then you'll have a 2-week break in between. So you'll have 10 weeks on, 2 weeks off, 10 weeks on, 2 weeks off, and each one is staggered. So then your equity curve, which may be up and down, not the full equity curve is felt on one account. And the benefit of that I found is certain periods you'll have like a lot of trades, and your winner trades go on all the accounts. That's when you hit the home run. But then also you'll have certain periods where you had a winning period but only hit 1 or 2 accounts. Okay, unfortunate. But then you have those periods where you had a losing period and it was felt on only one account.
Yeah, exactly.
So you can kind of even be a break-even trader. And as long as you have those bullish moments in your equity curve in a break-even period, you can still get good payouts on how you revolve the accounts. So that's how I would have done the diversifying approach of like balancing out or smoothing out an equity curve and utilizing other people's money. It seems like you're not doing that. Rather, you would trade multiple assets now and get into the crypto market, futures market, and all of these kind of things, and also different strategies. How have you been able to do that? To me, it seems like a lot of mental fortitude needed to balance that much more. How are you able to do that? So out of the dozens and dozens of prop firms that exist in the whole space, who can we really trust? Whether they use slippage, whether they use types of drawdown, unrealistic trading conditions, every single prop firm has hidden tricks. So after thorough research and speaking to a lot of traders, Alpha Capital is definitely the best prop firm in the space. So apart from their no commissions, low spread, no slippage, great reputation, never denying a payout, because you are a Titans of Tomorrow viewer, you get a special discount on every evaluation just using the link or using the code TOT for Titans of Tomorrow. Additionally to all of that, I'm also going to give you a community. So for everyone that uses the link below, you'll get a free trading care package, and you'll also get access to me on a Zoom call once a month, asking me questions, going through charts, real trading Q&A. And I don't need any money from you. I don't want anything from you. I just want to make sure you succeed with the best prop firm and some good education.
Yeah, it's interesting you bring this up, because when we last spoke, right, I had mentioned that I pretty much trade discretionarily. And we had brought up this conversation where if you're mechanical, you don't have to put as much emotional capital into managing those positions. Yes, it still is at the same time, but I find that having a more hands-off approach, now that I have other things going on as well, I find that my edge is actually improved because I'm more sharp when I sit down in front of the charts. I'm not so drained because I'm micromanaging all my trades and having to make those discretionary decisions. So now I think I'm just way more comfortable holding positions and letting the markets do what they need to do. But that's only really with the swing approach. Like if I'm day trading futures, obviously I have to be hyper focused and really in tune with the markets. So, you know, having those different strategies, my goal for really just as like a investor standpoint or a trader standpoint is to just reduce the emotional volatility in my portfolio or whatever, you know, all the assets that I'm managing. And I found that, you know, when that emotional volatility spikes, right, that's obviously when you're going to start making poor mistakes in the market. So I find that the best way to reduce the emotional volatility is to, right, have your allocation of capital split up. That way, if you go on tilt, the whole portfolio is not feeling like you just mentioned, which is definitely a con of the way I was managing it before, where I was copy trading just one market, right? So if I was only trading the euro, if the euro goes through a period of consolidation, now all of a sudden I'm either not making money or I'm taking losses just as part of the system. But if I'm trading other assets that are actually moving, right, I might be green in that specific bucket of capital, whereas the other one might be taking it.
What was the catalyst for this change? Because, you know, that saying of if it isn't broken, don't fix it. You'd already made such a significant amount in a specific way. What caused you to then, you know, actually have a complete shift in your approach?
I think it's just maturing as a trader and trying to find new ways to obviously improve the edge, but also to reduce the emotional volatility, because going through really long periods of tilt, you know, it's draining on your health, it's draining on your wellness, like everything that's tied to going on tilt. Okay. Right.
And right now, let's say the million or 1.5 that you have, how are you distributing it between asset classes and trade types?
So the trading style doesn't change across the board. So the same setups that I see that I'm taking on a daily time frame are the same setups that I'm going to take on a 5-minute chart. It's just the time execution, the window of how long you might have to hold the trade, right? So your average hold duration is just going to increase with the higher time frame. So it's less management, but they're the same exact setups. It's just I have to be hyper focused when I'm intraday trading. I just don't want to do that across multiple assets. It's just too much.
At the time, 7 months ago, you were not swing trading at all, to my knowledge. Now you've introduced that into your system. So is that a new strategy, or is it just holding your trades longer?
It's really just holding my trades longer, because I guess it depends on your definition of a swing trader. Because some people might say, "Oh, you're holding it for 2 days, you're a swing trader."
How are you defining it?
I'm defining it just essentially just based on a higher time frame analysis. So if I see a setup that occurs on a 4-hour daily, I'm like automatically classifying that as a swing trade, because now I don't have to check the actual trade for 4 hours or a day from now. That's the micromanagement part that I was trying to get away from.
So I did the opposite, where I used to be a swing trader and all focus on that, and I transitioned down to intra-session, let's say. But the way I did it was modifying the way I held the trade. My entries were the same in either way, where I would still look at, you know, premium zones. I'll still look at supply zones. I'll still look at lower time frame confirmations. I'll add a daily cycle, and I'll do all the same things. But now I'm just cutting it shorter. I'm cutting after the session volatility. Are your entries exactly the same, just aligned with a higher time frame zone and going for that new main push on the higher time frame?
Yeah, so the entries are the same. The management is different, though. Like you had mentioned, when it comes to my exits on the lower time frame, a lot of times I'll just be exiting based off the time. So if I'm looking for the opening range first before I enter into futures trade, I'm gonna look to exit before noon. And if my TP or my SL hasn't been hit by then, I'm gonna look to manage it, or at least reduce some of the risk by either scaling out a partial or reducing my stop loss. So it's very time based mechanically. But then when it comes to the swing trading aspect, I'm not really touching it based on time. So whatever news event's coming out, typically I would exit prior to a specific news event, whatever the case is. But if I'm swing trading it, I kind of try and filter out as much news noise as I can, unless it's obviously CPI or FOMC, NFP.
So when you're doing your exits on the swing trading position, is it just on key levels, market structure in your lower low, or is it upon key levels and then watching price action to confirm if it should reject or not?
Yeah, so a lot of times I'm waiting for some kind of confirmation, whether that's price respecting a certain level, rejecting or reacting from that level before I get in. And that's part of tape reading that's an experience that I can't pass down to other people. It's how does the market react when it hits a specific level? Because not every trade is going to move the same. If it's an important level, you should be able to see some type of reaction from it. If you're not getting the reaction, then a lot of times it's just a scratch. Whereas most people that are just strictly mechanical, they're going to take that trade every single time. Whereas, there's a part of a discretion where I can pass on some trades just based on the way the market's moving. Like if I don't see the bid and the ask line moving around a lot and reacting at a specific level, I'm most of the time just going to pass because I know that there's not enough activity.
So a lot of the swing traders that I've had on the show that have done well in their trading career, they are utilizing, seems quite rudimentary technicals. Some, for example, Burn, it just seems as simple as demand area on the daily, and that's about it. Because he's using a heavy reliance on fundamentals. To my knowledge, you're not really utilizing fundamentals. Am I correct in saying?
I do a bit.
Okay.
I do it as like a broad overview, but
Sure.
not to. If it affects my bias, then it's an issue. Right? I'm kind of using it as sentiment, and a lot of times I'm going to fade the sentiment. So I'll even look at positions from retail. So if everybody's short on euro, most of the time I'm going to try and lean long, especially if the headlines are leaning the same way.
Got it. So with that being said, still having a majority reliance on technicals, even for swing trading, have you found it more challenging? Because when you look at it from a fundamentals perspective, I understand the logic behind swing trading because that's what moves the market long term, and economy's health and news events and these changes will drive price long term. But from a technical perspective, apart from just overall trend, a daily trend, and hoping that continues, what else are you utilizing to kind of have overall directional bias and confidence to hold the trade long
Really,
term?
I'm just looking for market structure and order flow. Those are the two things that, to me, are the most important, because when the order flow changes, it's going to be very clear. Like
How are you
sometimes the
defining
order
that?
flow, fair value gaps. Most of the time, fair value gaps. So really large prints. When I spoke with Umar Ashraf, I believe they just call them single prints. So if you were looking at like a time and sales sheet, essentially is if there's thin liquidity, it's going to go print at a specific price, right, and leave behind a large candle that needs to be rebalanced at some point, right? So if we have one large order that comes through and the market spikes one direction, I'm just looking for a fade of that move to retrace and then position myself long. Or if that specific run fades entirely and then it takes out the other side, that's what I'm looking at as a change in order flow. Because why would there be a massive surge of buy-side liquidity being engaged in the market, and then why would it fade, and take out the low? That doesn't make any sense to me. So really, I'm looking at the emotions behind the market, and that's kind of what I've always based my trading on. And when it comes from a technical standpoint, I'm very rudimentary in my technicals. Like if I were to share my analysis, it's a couple lines and a couple rectangles. I've gone down the path of adding more and more technicals, but I've just found that the more you add, the more confusing it is. And really what I'm relying on is my ability to make clear decisions. So the more and more I add to my charts, that decision making, it takes a hit. So trying to keep it as simple as possible.
So someone that's gone deep down the rabbit hole of SMC, ICT, and everything technical related, and now it seems like you've done not an addition approach, rather a subtraction approach of let me simplify it and take the key elements and just a few lines and boxes. What are those few things that you have kept in your system?
Yeah, so fair value gaps, old highs and lows, so liquidity rates, premium discount, so using a Fibonacci. Those are things that are tried and true. Basically, there's three things that you need to understand which direction the market is going, because at the end of the day, right, what is it really doing? It's just going to go up or it's going to go down. It's how do I manage my emotions and my behavior around that specific market movement? Because if I'm making all these poor decisions as the market's going up one direction, I know it's not the market causing that negative P&L. Because I've seen times where I get the bias, the idea right, and I get my entry right. And where I messed up was the management, which is something that is, I would say the trade management aspect of it is probably has the highest skill cap for like ceiling wise. It has the highest skill ceiling because that's kind of where you can really squeeze the most out of your system. It's how do I manage my stops better? Right. How do I scale in better? How do I size better? Right? It's all of those things. How do I take partials better? Those are things that I think you're never going to be able to perfect, but you can try and perfect it as much as you can.
So to that point of if you have a profitable system, you have your defined entries, you have your defined approach and so forth, but then I could have that same system as you, but you maybe get more out of it because of how you managed it and not only the psychology of it, but also the approach to it. So that was a big FOMO point for me, and we spoke about it in the last one on take profit levels and how we do it. And for me, I was like, okay, we have all these key levels. We can look at rejections. We can also add emotions to it. And every time I was managing a trade, it would be slightly different. So then I fell back on data and I was like, okay, where is the optimal levels based on these trades? If I took partial here, what was my net result? If I took it here, what was the net result and so forth? And I landed on a 1 to 3, 1 to 10 fixed partial system. What is your system now? Because you mentioned you've modified your discretionary mechanical approach. So what are those changes looking like?
The average R that I'm aiming for is very similar. It's either 1 to 3 or 1 to 5. It's right in that range.
Okay.
Most of the time, and this is where I think is going to help a lot of traders, is I'm not moving my stops too quickly. I think a lot of new traders have that issue. They're trying to lock something in. And you have to give the trade room to breathe because a lot of times it's going to come back. It's going to retest specific levels. Those are times where you can scale in. But if you get knocked out of the trade, now all of a sudden your confidence takes a hit. And you might not want to re-enter. And I actually posted a P&L slip that I had just recently done a couple weeks ago. The same exact trades, going long New Zealand dollar. Like all 10 trades were going long New Zealand dollar. There was like 4 losses, 4 small losses, and 6 huge wins. So and once you get the higher time frame in line, it's just, do you have the confidence enough to take 3 losses in a row and stay with the same idea? That's something that, it's very hard to say because you have to build conviction around the market. Yep. And I think you only get that through experience. Like if your confidence is not shaken and you're able to go back into the market, that really tells me that you have experience in the market and you're very mature as a trader.
So these kind of 1 to 3, 1 to 5 zones where you're taking full volume or partial on your intraday accounts?
So I'll take a partial at like 1 to 1 if the time is up. Like if I've been holding the trade for too long and it's really just not moving, I'll take a partial at 1 to 1, or I might even close at break even. 1 to 2, sometimes I'll take a full depending on the market conditions. If there's enough room to run for 1 to 3 or 1 to 4, if I think that the higher time frame is really going to run for those levels, I'll just leave it alone. So
okay, so still slightly discretionary within there. So with that in mind, the partials that you're taking, is it targeting usually orientated around market structure, orientated around liquidity pools? Let's say targeting, we swept Asia high, we're going for Asia low. Or is it new low from market structure? Or is it just like the average daily range or the usual session range? What is it that you're kind of leaning towards?
So there's 2 things. There's time-based exit or liquidity-based exit. So if we hit a key level and maybe it's not the time window, I'll still take a partial. Or I'll take a partial if we've taken out a level and then there's a news event coming up. So a lot of times that could be the signal of a manipulation prior to the news. So it really depends on the actual condition of the market. Like if there's a high impact news event coming out tomorrow, but I don't think it's really going to be a market driver, I'll just leave the trade alone. But a lot of times if it's a really high impact news event, like if it's CPI and we've taken out an important level, then I'll collapse the position. So it's really dependent. And that's just from my experience. I've given back a ton of money holding trades above old highs going into news or below old lows going into news.
So coming back to the swing approach that you had, you were talking about order flow and how the fair value gaps kind of confirm intent in the market, I guess. Say, okay, I have confidence to hold the trade because the fair value gaps, therefore intention is still there. And the moment they start to diminish or get counter fair value gaps, it's like, okay, we're getting exhaustion. Is that kind of how you summarize it?
Yep.
So with that being said, I do something similar, but I'm not looking at the fair value gap as the main thing. I'm using that as the mirror for the sweep. So if I see, for example, I've come to a supply zone or preferably ran it, I call it an inducement, swept the high of a daily zone, let's say, and then I see a strong rejection. I want to go with that trend. And then if I usually exit on the same day, but the next day, if I'm seeing a run of liquidity high and then a imbalance or, strong rejection, I enter again. And that's how I follow that higher time frame trend. But I'm just entering again and again every day when I see that sweep. And then I'm just maximizing the risk reward per session for the session volatility. And it's, and when I used to do it, I'd take one swing trade and I'd hold the whole move. Now I felt like just taking small pieces of that same move, but not just getting the pip counts rather than those RRs that really add up. That's what I found most effective. So I want to kind of hear your thoughts on the fair value gap leading the trend as your indicator of confidence, as opposed to the sweeps. If there's anything in there.
The hardest part about me talking about a model is because I understand all of it. Like I've gotten to the point where I've traded liquidity sweeps enough, I've traded order blocks enough, I've traded fair value gaps enough, but most of my entries are coming off of fair value gap. If the sweep in my eyes is a major indication though, it's just how do we react off of it? Because I know there's a lot of traders that are going to trade every single sweep, but you have to see a major reaction off of it. You have to see a long wick from a specific candle. That way you know that that's the actual rejection, or taking that specific liquidity is the actual inducement. Not just as soon as it goes below the low, I'm going to buy long. You have to see the reaction, right? You need to see it reject the low first.
And coincidentally, that law of cause and effect, if you have the cause of an inducement, the effect has to be intense.
Yeah.
If you've got liquidity, you need to see the result of that. And usually the sweep leads to an imbalance or a fair value gap. So actually, they usually go hand in hand, which is why I asked that question of why do you not use both or use the sweep rather use the fair value gap?
Well, I think there's different intent behind it. I always go back to pit traders and how they used to think, right? And really, the markets haven't changed since. Yes, you could say there's all these algos and everything that came into the market, but when we're talking about the markets, it's really just time and price. So all of the videos that I used to watch of all the pit traders, essentially what you're trying to depict is maybe there's some new guy that came into the pit that day, right? Or a group of new guys that came into the pit, and they have a specific low in mind, and they're going to go long. And you can kind of see that they have a weak hand, right? The intent of the experienced traders on the floor is to go take out that liquidity, right, and then reverse the trade on them, right? Because now all of a sudden those people that went long are trapped or stopped out, and you're buying the position from them. So if you're trying to be a liquidity provider, right, you're trying to take the other position from the weak hand, right? So that's really the intent of a liquidity rate, whereas a fair value gap is more of a displacement in the market. Now we have a bunch of seasoned traders coming in and going long on a specific market, right? So there's two different intents with those different setups. It's just painting the narrative behind them is the most important, I think.
So now that you've done this, kind of absorbed everything in the industry knowledge-wise, tested them all, traded them all, and then kind of retreated into a few, fair value gap seems like one of the most important ones. What else is on the list for you?
I think premium discount levels, just knowing where we are in a specific range. I always, and I mentioned this to my students on my call the other day, was when you're taking a position, just look at where the bid and ask line is relative to the current market structure, relative to the specific levels that you're trading. And if you were to place that position right now, how is that going to look? When you plot your take profit and SL levels, does it make sense, right? Has the market even pulled back or induced a specific level for it to make sense? Because that's kind of how I reduce the FOMO is, when you see a market rip and you're not on, a lot of times you're going to have that FOMO effect and you're going to want to enter the trade. But is it really the best position? Is it really the best price that you're going to get? Right? Because they were just buying it at, say, $1. Now it's at $2. They were just buying it at $1. So would it make sense for me to buy with the herd at $2 or wait for it to come back to a level that I know people were willing to buy it at $1 or say $1.25, right?
Fair enough. So when we last met, and it seems like the majority of your career was spent in FX, Since then, now I guess because of prop firms, or I want to hear your thoughts. Why you transition towards futures? And before we get into the benefits and pros and cons, I want to kind of hear what was the driving force behind switching towards futures.
I wouldn't necessarily say that it's been like a major driving force. It's just another market that I'm trying to test. Okay. Obviously, their benefit is that there's no spreads. And if I were to go with personal capital, right, at least my capital's insured at a specific broker that's, regulated by all the bodies in the States. Those are, I think, the two main benefits, as well as tax purposes, right? I believe 60% of it is getting taxed at short term, and then 40% is getting taxed at long term.
Okay. What about actually trading it? The technicals, have you found them cleaner, harder, any benefits in there? The key one I want to mention is in futures, you have access to volume. And that sounds like a game changer. So I want to hear your thoughts on it.
Yeah, and I actually talked with Umar Ashraf about it because I know he uses footprint charts, and that's definitely something that I'll possibly look at is using footprint charts, just understanding, what's going on actually behind the candles. One thing I would say is between FX and futures, the volatility is way different. So you might get volatility overnight or throughout a long period of time on FX because it is a 24-hour market, right? So it could happen at any given time. Whereas futures, I think, is way more concentrated to a specific time window. You're not going to get a major. I mean, there are moves that happen London overnight, et cetera, but I think the majority of volume is occurring within like the first 2 hours of a specific session.
Okay, so that brings me to the point that you mentioned of time and price. Define to me the importance of time and price.
So, I mean, really, when you think about a chart, right, it's just X and Y axis. So that's the importance of it, right? If you just remove the candles, right, that's really the only thing that matters, and that's kind of how I'm trying to look through the candles. I'm not looking at the candles and saying, "Oh, there's a massive candlestick pattern here. Let me trade that." I'm really just looking at, what time are we based on the calendar of events, right? Maybe we have FOMC coming out on Wednesday. A lot of the times, I'm not doing anything because I want to think like a fund manager or a specific institution would, right? Would they want to position themselves before the Fed is speaking? To me, that doesn't make any sense unless you have insider knowledge. So a lot of times I'm basing my weekly plan around the calendar, and then it's, when should that volatility hit the market, right? And do I want to position myself before or after? That was one thing that I had a really hard time with coming up, was not knowing if I should position myself ahead of a news event or after. And that just comes with experience. You have to test both and figure out which news events are tradable and which ones aren't. Which ones you should have to steer clear of.
So a big portion of my own trading is what I refer to as the daily cycle, and it's utilizing time and price and saying the tendencies of the time of day and how it plots out during from Asia to Asia. And I found so many models in that are so repeatable, and it's pegged to the hour. And it's crazy for me to see like London Open, boom, it happens. Frankfurt Open gives an early move that gets swept more often than not. Frankfurt Open becomes a trap point for me. So just kind of getting into the daily cycle a bit. Asia range is usually consolidation in a form. London expands, usually gives a reaction, and then New York can be a continuation or reversal. A very basic format. But I haven't found, or I'm not using, let's say, a way to do a weekly cycle. And now that you've introduced a swing element, and maybe through the depth of knowledge you have, I want to hear your thoughts on time and price beyond just day to day, rather the full week.
Yeah, exactly. And this is where I think ICT really excels, is having the weekly profile. So yes, there are templates out there, but it's how do you apply that specific template to that specific week, right? So if, let's say, CPI will release on different days during the week. So Tuesday, Wednesday, maybe. How is the market going to form during that specific week? Because a lot of times, like you mentioned, there's specific times in the day where it's going to create the higher low, which a lot of times, if you guys were to look at your charts, right, in FX, a lot of times the higher the low is being made right around either London session, New York session, and then the opposite end of that range is going to form right around London close or 2 p.m., right around there. When it comes to the weekly profiles, right, you have to look at the calendar and say, all right, what are the most important events of this calendar and which ones are going to drive volatility, but also which ones might cap the other end of the range? Because a lot of times, and I had just seen this on, I think it was the New Zealand dollar, somebody had brought it up, well, they wanted to go short on a specific market, but it was already Thursday, and we had already taken out Wednesday's low, right? So when you're looking at that, after we've already sold off for the week, I'm looking at that and saying, how much more, as part of an average weekly range right now, how much more room does it have to run lower, right? Because everybody's already on board with a short, and we're approaching the end of the week. So essentially, what I'm doing is taking the magnifying glass, I guess, going backwards from your daily cycle, going to a weekly cycle, right?
Okay.
And it's very similar if you were to do the same thing on a monthly time frame, right? Because you have NFP possibly causing a consolidation, the second week possibly causing the manipulation, taking out either the first week's high or low, and then possibly going the other direction, right?
Interesting.
So that you have second week maybe making the high or low of the month, and then maybe by the third or early in the fourth week, capping the other end of the range.
So the daily cycle one I think is rather easy to grasp, and yeah, that you can really model them out. The weekly one I haven't got around to. I haven't. It's not useful to me because I'm in and out in the same day. But I want to hear your thoughts on like the repeatable ones that you've seen are very common. If you can kind of describe a very typical weekly cycle profile.
Yeah. So this is one that I've been trading for years now, and I almost would say like it's a trade that like I kind of bet the house on, even though I'm known for like saying risk a 0.25%.
Yes.
It's a trade where the weekly opens up and it trades one direction straight off the bat.
Okay.
And then we have some specific news driver towards the end of the week. I'm looking for a reversal signature to turn around and then go retest the weekly open.
So talk to me that day today. So Monday, Tuesday expands, let's say bullish.
Yeah, just one direction. There's no price action on one side of the candle.
Okay, and then Tuesday, Wednesday, Thursday, it starts.
I'm looking for an exhaustion move, so maybe a run up into a higher time frame liquidity level. So let's say if I was bearish, if I had a bearish bias, if that week opens up and it goes straight up and takes out an old high, then I'm looking for the reaction, the change in order flow, and then at that point I'm just really targeting a run towards the weekly open. It doesn't have to go back to the weekly open, but at some point, yeah.
And that entry will usually be after taking an old high through that week open run. And then I guess midweek, Wednesday, Thursday, you're looking for rejection profiles to sell into that same open point.
Exactly.
So the hot moments, when are those entry days usually?
A lot of times it's going to be Wednesday or Thursday. Yeah.
Okay. And usually have you found it gets very volatile towards the end? Or
yeah, exactly. So it really depends on the calendar, right? So if there is a specific news event, FOMC is a great example of it. If you see FOMC taking out a specific level, but your bias for the week was the other direction, and we've traded away from the weekly opener, weekly open one direction, then you're all the stars are basically aligned for it to go the other way. Because if you're thinking about a candlestick, right? Every single candlestick forms the same. If you're looking for a bearish candle, right, 90% of the time that upper wick is going to form in the first 50% as far as time, right? So if the upper half of the wick is going to form Monday, Tuesday, or Wednesday, the lower half should form towards the end of the week.
Interesting. Right? So you can kind of pair the candle profile on a higher time frame with a weekly or daily profile, let's say, of some sort of expansion manipulation and retracement, whatever it may be. And then it gets condensed into a candle. So you're using that candle open, high, low, close profile with a weekly cycle templates.
That's all I'm thinking about. I'm only thinking about, and that's like, I think the biggest picture is like step one is where's the next candle going to go? Whatever time frame you want to think about. Then I'll dive into the lower time frames and find all the signatures that I'm looking for. Market structure, fair value gaps, things like that. Just as like a magnifying glass.
And what is the best way to predict what that next candle will be on a higher time frame? As a trader, it's very simple. You have to find an edge and then you have to have a mind so you can follow that edge. But how do you know if you're performing correctly or not? You have to know your data. And TradeZeller is going to show you everything that you need beyond the surface level win rates and performance and equity curve. It's going to show you detailed reports. It's going to be your backtesting tool, strategy testing tool, playbooks, notes, and it's going to be a full journal. It makes your journaling easier, faster, and more meaningful. Whereas if you were just documenting on an Excel spreadsheet or taking screenshots on your iPhone, you wouldn't be able to pull out the data that you need. The correlations that the AI within TradeZeller is pulling out for you. There's so much variety and utility within the software that I think it's essential for any trader. So the link somewhere below is going to take you directly to the TradeZeller website. I'm not getting paid. This is for you. If you want it, if you like it, go ahead and explore it. And probably you'll be using it for years to come.
If it's very clear, if it's extremely clear, like it's jumping out, and I know that there's another level, let's say on a weekly time frame, we've taken out last year's high, right? And we rejected. Now, all of a sudden, I have a really strong indication that it's going to go lower. If we have maybe equal lows below us, or if we're like really extended.
So let's say an example that we come into a daily supply area, very clear supply zone, daily order block, and then it wicks out and gives like a doji candle. you know the high probability that the next day or the next week is going to be a bearish candle, and then you go Monday, Tuesday, Wednesday, look for that manipulation, and then sell into
Exactly.
it. Okay, very interesting.
It's just
And does that
repeatable. I
favor
do the
your-
same thing week in, week out, really.
Okay, and does that favor therefore more towards swing trading, that kind of modeling?
I mean, it works on every time frame, to be
Okay,
honest. It's just how hyper-focused can I be to make the decisions fast enough
Yes.
on the lower time frame.
Now, another thing I want to get into, based on the fact that you have access to order flow in futures, which is something you're not used to in FX. Obviously, we utilize liquidity a lot, but in the FX realm, liquidity is based on what we see on the left. And it's always going to be predicting, and I kind of just refer to as predictive liquidity of we see these equal highs. We know that people are going to enter on that resistance level, stops above. So therefore, a run of that liquidity would be a liquidity pool. Same thing, you see a very obvious trend line, just a quick spike of that. We'll get the breakout traders doing the break test bullish, and then you sweep the stop loss of the sell. So that run of liquidity is something you could predict. But also you need to see the pool, then you need to see the price action, confirmation of a rejection, and then you sell it accordingly. But with all these things being said, we're still looking on the left, speculating, and hoping our rejection is a real one. Whereas with the same profile, adding order flow, you can add another layer of confirmation because you can see, is there really liquidity there? Is there really intent there? So have you found any way to kind of correlate that information?
Not quite yet. I know that there's tools like Bookmap. I think it's Bookmap or Heat Map, something like that, where you can see how much liquidity is at a specific level. But I think I've gotten to the point where I've been trading without it so well that it's like, all right, if I do add it, now it's like a whole different thing that I have to learn.
Okay.
But yeah, essentially I'm just looking for the reaction. If there's a large reaction, I know that a lot of liquidity is being engaged.
So I put a tweet out and it went kind of really debating in the comments. And it was the question I asked people, and I don't have an answer myself, which is why I asked it, is would you rather be a world-class person that, I don't know how to say it. Would you rather be someone that gets world-class entries? You're just a sniper at getting entries, you perfect your entries. Or would you rather be a master and world-class at directional bias if you had to pick one or the other?
I would say directional bias. And I mentioned this to Casper actually on his podcast. I was like, if you get the right directional bias, you can be very sloppy with your entries and still make money.
Mm-hmm. And what about the counter side of you can get sniper entries, you get the directional bias wrong, but you just break even, take a partial along the way, and kind of stack it up. That was kind of the debate in the
I guess
comments.
both could work, right? Because if you have really sniper entries, then you can really just play risk reward in your favor and not worry so much about bias. But me personally, I think I would prefer bias.
Okay.
Yeah.
So right now, what is your entry system based on the fair value gap, the sweeps, and you the candle stuff we've spoken about, the cycles we've spoken about. Now you've decided I like this zone, I like it in this time window. I need to now find a confirmation to get in. What does that look like to
you?
you?
Very simply, I would say it's a power of three. So if you're not aware, power of three is just accumulation, manipulation, distribution. But what I'm thinking of is, let's say if I'm trading a daily cycle, I'm looking for a run lower below the open, right? That to me is where the best pricing is going to be offered. If it runs away from me, a lot of times I'm just passing on the trade. So if I'm looking for a bullish daily candle for tomorrow, right, the best opportunity to enter long is going to be below the open. If it expands above the open prior to me finding a trade setup, a lot of times I'm just passing on it. Okay. So I'm trying to find the best price, right? To me, that could come in any form of entry model. It doesn't matter to me if you're using trend lines, if you're using, kangaroo candles, whatever you want to call it, pin bars. To me, the best traders can position themselves inside of a wick, because when that run happens, they're already on board, right? So if you can't do that I would say is the number one thing to focus on. Is if you're expecting a bullish move, the best entries are going to come when the market looks like it's going against you, or it's going against your narrative. So I guess my best entry model is understanding the time frame that we're in. So if it's a daily cycle, right? When the news event comes out that I think is going to inject volatility in the market, where are we trading, above or below the open? So if it's a news event that I'm willing to trade, let's just say it's PPI, and I have a bullish bias on the week, I have a bullish bias on the day, and I come to my charts at 7:30 a.m. Eastern, which is like 1 hour before the news event actually occurs, or let's say you even came to the charts 15 minutes beforehand, and we're trading below the open, and I have all these signatures. Let's say maybe we took out yesterday's low, maybe there's a fair value gap that appeared below the open. I'm just going long and not thinking about it so much, because I know even if I get it wrong, I'm still getting an efficient price if the market expands higher, right?
Okay. So it seems like your preferred zones are when you're in a absolute discount and you maybe even sweep the structure points, or in absolute premium, sweep the supply points. And then you can predict based on the rejection, the next day should be a follow through with that trend, let's say. So it kind of entices you to enter in extreme zones. And obviously, majority of the week, majority of the year is not spent in the extremes. It's in the expansions. So are you able to then also confidently enter in like no man's land in the middle of an impulse? Or would you rather trade another asset that maybe?
Well, I can enter a no man's land as long as we are at an extreme of the no man's land, right? Because we can really dial in. Let's say, yeah, exactly. If it's been consolidating for a month long, just really dial in and just say, all right, maybe I'm trading this very small zone. It just has to be an extreme of that specific zone.
Okay. And what time frame are you allowing yourself to judge a impulse or range by? I mean, you can get absolutely fractal, but
that to me is very subjective, right? Like I think the impulse legs that I try and find are the ones that are really obvious to me. Like I know a lot of people will try and find breaker. I don't know if you're familiar with the breaker setup.
Oh, not the setup. No.
Just it's like an order block prior to a run on liquidity. So it's just the market structure shift.
Before the run of liquidity.
Yeah. So like you have a low, a high, a higher low, and then a higher high, and then we break the higher low.
So you're kind of like testing the neckline, kind of thing. Okay. And what
people are not gonna like that you said that, but
okay, my bad.
Yeah, essentially.
When you are in kind of that no man's land, the reason I asked this is because you had the next daily print to predict the directional bias. So you know that you've swept liquidity, you've got a doji, you should have a follow through. Now, if you're just using M15 extremes, let's say, just to put a label on it, are you doing the same thing again? You're waiting for that sweep, and then you're waiting for a rejection candle, knowing the next one will be the follow through, just on a smaller time frame.
So I think this is where a lot of experience comes into play, is knowing what type of market condition you're in. Because some people will say, we're in a trending market, even though it's a consolidation, vice versa, whatever the case is, but you have to adjust your strategy based on the condition that you're in. So identifying the condition first and foremost is going to be important in how you're actually, interacting with that market.
Mm-hmm. You mentioned earlier on Fibonacci, and what I understood it was that just to know what's premium, what's discounts. Are you going beyond that and actually using the fib levels themselves?
Not necessarily, because I've studied them long enough to know that they work. But what I've noticed a lot is these fair value gaps, they're left in premium discount a lot. So if you see an impulse leg and you just draw a Fibonacci, you're going to find a lot of fair value gaps resting in discount.
Mm-hmm. And when you when you found those kind of preferred fair value gaps, what is your qualification process to not trading every fair value gap, to actually trade the quality?
Really, it's just the reaction from it. Okay. So I need to see that specific fair value gap get traded into and rejected away from before I actually take a position. And then it might be something as simple just as an engulfing candle, doji, just actual price action, which is interesting to bring this up because I know a lot of people in the industry are like, oh, candlesticks don't work. What do you mean they don't work? What else are we using? We're looking at candlesticks all day long. Of course they work. It's just time and price.
Yes. And bringing back to we talk about price, what about time? What have you found most effective in terms of, is it down to the minute, down to the hour? What are you looking at in time?
So let's say if I'm just trading intraday, I'm really just trying to predict the next hour, 2 hours, right? So when it comes from a timing perspective, understanding that when we get towards the top of the hour, we might get a retracement on that candle. So the last 15 minutes of the candle, if it's pushing for new highs, I'm usually taking partials off because we might leave a wick by the end of that next hour, right? Okay. So from a timing perspective, always thinking about how this candle is actually forming. Because I've seen a lot of trades just go against you, especially if you don't take a partial off and the last 10 minutes of the candle, all of a sudden it completely goes against you and you give back 2-3R, right?
Okay. I've seen actually, maybe it was your charts. It's you have price action, let's say M1, M5, and then you have one candle showing.
Yeah.
And is that the daily candle showing?
Yeah. There's a tool out there. It's high time frame PO3 by 2 degrees.
Okay, and
which I find extremely, extremely useful.
Yeah, I was going to ask, so when you have your normal price action showing and whatever your preferred time frame is to actually execute, and then you have the reference of the daily candle and you see how that's modifying, how are you utilizing that correlation or information between current price action and the daily candle?
Yeah, so again, it goes back to just positioning myself inside that higher time frame.
Okay.
If I'm, if the hourly candle already moves my direction and I can't get a position below the open, I already know that I'm at a higher risk because I'm not getting the most efficient price, especially if it went and printed the low already, right? If it went and printed the low already, and let's say if it took out the previous hourly low, I might have already missed the move because I know that there's some guy out there that probably made $10, $20, $30,000 because he's the guy that entered at the low.
That statement of if I know it's already printed the low, how can you know if it's already printed the low of the candle?
Yeah, the rejection away from it. Like, and I think that's where I don't necessarily need the order flow because I can pretty much tell when there's a lot of activity and you see the bid and the ask line moving around a ton. When we go sweep a low and it moves around a lot and then we print above the low again, that's kind of how I can tell that this market is possibly ready to reverse and go the other direction.
Mm-hmm. Now pivoting towards prop firms. So you also mentioned at one point you were 5 or 6 million. Now you're down to 1.5. What happened?
Well, I mean, a lot of firms went under, right? And I think this is where maybe the viewer base just needs to be educated on what the model actually is, because I think there's a lot of misinformation too out there with people thinking that a lot of these traders are getting A-booked, which in my opinion, even if they say they are, let's say if you were running a fund, how would you qualify your traders? Would it just be
it's truly impossible because even if you have someone that's got 2 months of profitability, I spoke to a few founders of prop firms and I asked them, like, because brokerages sell the data or they use the data, even if it's not in-house and hedging, they will just sell the data. I said to the few founders I know, why don't you just sell the data and make a revenue stream out of it? They said because the data is useless.
Yeah, it's bad flow.
The brokerage, at least someone has got their real capital, so they're not going to wake up and be a full degen. They might have emotional moments, but when it's a prop firm, it's like people know it's not their money, and they might trade so sensibly, they might even get a payout, and then one day decide, let me put a max daily loss trade and see what happens, and therefore that kind of messes up the whole data within there. So yeah, A-booking, I'm not a believer in. I don't think any prop firm is doing it. Even the ones that claim it are probably lying. And the ones that are doing it, they'll be doing it in a very specific way, which is not going to be A-booking on an individual level, rather A-booking asset classes. Which okay, a lot of people are long on this and short on this, and they'll do overall hedging. So I think the accurate word, I spoke to a founder, he said...
it's not necessarily A-booking, because A-booking is like...
Yes, A-booking is just literally copy-paste, but sensible brokers and firms actually hedge. And it seems like A-booking, but it's something a bit more to it. That one makes sense to me, but a lot of firms, 90% firms, I don't think they have the tech or the knowledge or the manpower to do it effectively. Yeah.
So really the issue with a lot of these firms going under is not because they're rug pulls, and we'll be just clear about that because a lot of them just label as a scam. And this is coming from somebody that I've always used a service just to see what it's like. You know, I've used some of the firms that seem the most scammy, but it's just the cost of business, and the opportunity was I might get a payout from them. Right, so I feel like I'm in a position to be able to review every single one because I've used every single one of them, and I've paid with my own money to have all these accounts. I'm not an influencer that just gets free accounts from people. They won't let me trade on the platform essentially. Like, what would be the benefit of you giving me a free account, especially when I've proven that I can, pull a ton of money just from one account without blowing any. So really, the business model for a lot of these firms is cash flow, and that cash flow comes from failed traders, and when a lot of platforms go down, when U.S. clients, they lose, a lot of those firms lost MetaTrader, which is probably a huge hit to their business. There's other issues that pop up, obviously, but a lot of firms go under because they can't manage the cash flow. And it's just part of business, honestly. If you don't have a big enough reserve, and part of that is probably because some of the rules are changing. The rules are, I would say, a little bit too easy. It's been a race to the bottom where the rule sets have gotten probably way too lenient on the FX side, whereas comparing with futures, we can talk about that space for a little bit, but you haven't really seen a futures firm go under, right? It's because I think the rules are so much more strict that I think that their pass rate is probably lower though too, and the ability to make money is probably lower because you're not seeing huge, massive payouts from Top Step or anything. You might see some here and there, but those are probably unicorns.
So it's kind of a catch-22 because you want to be with a firm that gives you favorable conditions as an individual. I'd rather to have the best conditions possible. But you also know that as an industry, as a firm overall, if they're too favorable, they can't sustain as a business model. So our relationship with prop firms is we want them to be as favorable, but because we have misaligned objectives, they make money when we lose money. So therefore, we have to hope that they are vastly profitable to absorb payouts. So that becomes the balancing act that is there. And it seems like a lot of firms got it wrong and went under. How do you assess the futures of the prop firms in the FX space first?
So I honestly think they need to go back on some of the rule sets. And I know people in the space have already talked about it. how badly is it going to hurt to go back to 70% payouts or 30-day max passing? I think I think people would prefer to have the opportunity at all these firms and have these firms be sustainable and around for business rather than offering easier rule sets with the risk of them going under in a month or two. Because I would have preferred if all the firms were able to manage the cash flow better and still be around, obviously, because the more capital you have, the bigger opportunity you have. But as I guess on the other coin with futures, right, the rules are much harder. They're not giving you as much leverage. You have to make more to pass, and they're giving you a tighter drawdown. Like I think some of the drawdowns are like 3.5%. So you have to like really trade extremely conservatively. Apex especially because they have an intraday trailing drawdown. So those are things that you could possibly look at that and say, oh, that's predatory. But I think if you can get past that hurdle, right, you have to adapt to that style of trading, and that's why I think it's way different than the FX side, where I think that's probably where it hurts the firms on the FX side, is they're allowing people to trade through the news, or they're letting them swing positions, which you can't do in FX, right? And there's a reset. So once you would get a withdrawal, you still have the full drawdown. Whereas a lot of those futures firms, if you withdraw, it's more like the one step. So with one step, if you withdraw, now you have to leave a buffer essentially. So you can only withdraw X amount. You can't just get an automatic reset on your full drawdown amount.
I see.
Right.
I see.
So there's small rule differences between the two firms, but I think right between FX firms and futures firms, you probably see way more bigger payouts at FX firms, just because I think the rules are a bit more lenient. Not saying that people aren't getting really big payouts at futures. It's just probably smaller as a whole.
I'm seeing a new trend pop up in terms of a buzzword, which is new prop firms popping up or old prop firms that went down, revamping and so forth. And they're just coming with, we got investors or we got XYZ and we're now using real funds. And for some reason, people are like, yeah, I really need the real funds. Well, the reality, I think it doesn't make a difference. If it's real funds, fake funds, simulated, whatever, if I get the payout, I'm happy. As long as the firm is healthy and can absorb payouts, that's what I'm after. Why do you think this trend is coming towards real funds, and do you even believe it?
Yeah, I think it's like a psychological trick. To me, if you know how to trade, it doesn't matter what medium you're using, right? So if you can do it in a personal account, you should be able to do it in a prop account. You're just managing the risk differently. Maybe you're managing the rules to fall within that specific rule set. But at the end of the day, does it really matter if you're trading on real funds or not? Because I guarantee if you give your money to a broker, they might not even be using your real funds in the real life market.
Most likely
right?
not.
So like if I give my money to Oanda, they're probably just going to B-book me anyway. So I'm essentially on simulated funds, right? When they credit my account, as soon as I give them the wire, do they even have the money on that end?
Okay,
they might not.
This is a big question I've had for so long, and I didn't know who to ask, so I'm going to throw it to you in hopes that maybe you have an idea. So we see liquidity in the market. We've spoken about it. We spoke about how we see the runs of liquidity, the sweeps, inducements, how it works, how it rejects, and the evidence is so clear in the market that I'm in 100% belief. Liquidity exists. Retail traders, liquidity exists. We can see it. We can see it getting manipulated. But when I take a step back and I think retail liquidity, you and I, is such a drop in the ocean to the funds and the billions that is invested there. Also, most likely, majority of retail traders, that is the drop in the ocean, is probably B-booked on a broker or in a prop firm and simulated. So when I see these retail levels, trend line, or even a smart money zone, XYZ, getting swept and then real rejection, I'm like, that was a 5-pip run. It's the only reason was to grab liquidity. I can't justify it any other way. But then the liquidity of retail traders seems so insignificant. Any thoughts there? Because I have no idea.
Yeah, I mean, to me, I guess I'm putting everybody in one big pool. I'm just looking at it and saying, all right, these are the losing traders, and I want to be a winning trader, right? So if I just align myself with the real move of the market, it doesn't really matter who's on the other end of it, essentially. I just know that there is liquidity there, right? Because obviously, why would a market react at a specific level if there wasn't?
Yeah.
There's going to be somebody that gets trapped in the market. And I actually brought up this documentary. I don't know if you've seen it. It's called Floored. It's about all the pit traders back in like the 80s and stuff. And you could really see the emotions of these people. It was like when they were transitioning to electronic trading. Okay. Some of these guys were like, that's never going to work, or I don't know how to make money doing that. You could just see on their faces how visibly defeated they were. Just imagine that same person like in the pit when their stop loss gets taken out. That's kind of what I'm trying to envision when an old high or low gets taken out. I don't care if it's like a banker getting taken out. I don't care if it's a retail trader. I just want to be on the other side of his position or her position.
So in the last 8 months since we spoke, obviously the terrain has changed a lot, and you've lost, through no fault of your own, like 80% of the capital you had at one point. And there's probably certain emotions behind that. So before we get into that journey, how much in, let's say, payouts were denied, or how much payouts are pending that you deserved and earned, but the industry kind of took it from you?
Well, so I am owed $70K from a firm. I won't name names, but it is just one firm because we don't have too many options in the U.S. So I'm still waiting for $70K from that specific firm. But other than that, I haven't been denied a payout or lost any large payouts for whatever reason. Like, it just, when the cards came down, I wasn't in a position where I was requesting payouts. But I have lost payouts before from firms going under, like my Forex funds. I think I requested right before they went under. The other one, there was one in Australia, the prop trading. They owed me like $20K. So total, I haven't lost that much. I mean, yes, it sounds like a good amount, but I know there's traders out there that have lost more, like Dan, for example.
Yes. So when it comes to like the conspiracies I see on Twitter, they're like the payout denials are not in the favor of influencers, known traders like yourself, because they don't want the bad PR. And some people say that that's the surface, but the average trader, the average guy that it doesn't really have social media or whatever, they're the ones really getting screwed over and getting really denied payouts. Do you believe that?
I would say it's kind of like 50-50. Like, I hadn't been denied a payout before I built my brand. And I think now that I do have a brand, yes, possibly I will get favorable treatment. But that was a risk that I took, putting my face out there and stuff, because I wasn't comfortable talking about my story. I wasn't comfortable talking about trading in general. But I would say, there's a risk either way, right? There's a risk that the vehicle that you're using might not be around in the future, just for the business model reasons. But as far as people losing payouts, that I think, let's say if they don't have influence, right? I can only observe from the outside. I don't actually know what's going on, because I have seen people complain about payouts when they've broken rules before, though, too. And it's like, I try not to let all that noise get to me, because at the end of the day, I don't really know who these people are. Maybe they're right, maybe they're wrong. I don't know. If they are being denied payouts, then obviously there's room to improve in all areas when it comes to this specific industry, right? The rules need to be crystal clear, right? Some of the rules are vague, where they have reason to deny your payouts. There's other reasons why maybe they're denying payouts, which I can't get into, right? Some people are saying they have multiple device IDs showing up and they've only used one ID. I don't know if that's real or not, right? You don't know. Only the people that work at the firm know, because even the influencer that's maybe saying, oh, this is what happened to my payout, I don't know if I need to believe you or not, right? And that's not really my focus, right? I'm only focused on if I'm having an issue, which currently I am having an issue.
And it's not helping being an influencer. So I want to kind of get into that point, because whenever I post a YouTube video or a podcast, and I've seen everyone that has a brand, in the comments, there's always someone there saying like, well, if you're really a trader, despite all the proof you and I have shown, if you were really a trader, you wouldn't be making YouTube videos, or you're just doing this for the AdSense. Just a disclaimer, my AdSense doesn't even cover one salary or one student. Like it's so irrelevant.
Now that my YouTube is monetized, I'm like,
you realize
these guys
it's
are
so
not
small.
Yeah.
And the payroll that I have is compared to the income I have, is out of pocket every month for the last year. So it's not even in that. But I just want to hear your thoughts on, to those people that are like, why would a successful trader, even be on Twitter, Instagram, so forth?
Yeah, I mean, I think it's just really like a lack of education, but also skepticism. And the way I look at it is, skeptics don't necessarily have the same ceiling of education as other people, because you need to be able to have an open mind and be flexible in your understanding. Let's just say, for example, I told you I can make $1 million in the markets. The skeptic says, no, you can't. You can't do that. Whereas the person that has an open mind says, I don't know if you can, but I'm going to try and find out if you can. Right? That was the same perspective that I took when it came to trading, because when I came up, I didn't know anybody that was a profitable trader. So I wanted to find out on my own. And the only way you do that is just by walking the walk. So there's so much skepticism, though, on the internet space. It's almost like, I don't know how to put it, but you kind of have to block all of that out, because I can just imagine, the way that I look at it is, if I get a negative comment, I just don't have time, honestly, to even pay it any mind, because now my energy is going towards that. So essentially, when I see skeptical comments, I just think to myself, well, that's fine. I just know that that's the person that has a fixed mindset.
So what I found is, and I made a video on it on the solo shoot of the podcast I do sometimes. There's different types of learners, and you have a winner's mindset. The example I gave was the guy that broke the 4-minute mile, and it was never done in history. And he was like, the mindset of certain people are like, doesn't matter what anyone says, doesn't matter what the odds are, doesn't matter, as long as it doesn't break the laws of physics, I will do it and I'll find a way. That's absolute winner's mindset. Then you have the people after him that saw him broke it, and then they broke a limiting belief. They kept pushing and they did it. So it's like, other people can do it, so therefore I can do it. Still a winner's mindset. Then you have the next layer, which is like, I see people can do it, but I'll see if it works for me. They're already coming a bit like passive. Then you have other people like, I see it works for other people, but I'm unlucky. It doesn't really work for me. Then you have the last one, which is like, I know it won't work and I'll prove it to you. And that's kind of the absolute skeptic.
Yeah,
so this kind of layers of people is within society. And when I see the comments of the haters, I know where they are.
Yeah.
And it's
I think that they're the most vocal as well. I think the absolute skeptics are usually the most vocal.
The guy that's winning, he's too busy winning. The guy that's losing is like, I'm going to go out my way to show you, despite all the results I see around me. And when I look at that a little bit deeper, I'm like, well, it's not like it's genetic. It's truly environment. And I had a very good podcast with Abdu. He's in Toronto, in Canada. And he said, if you're born in a bear market, you will have a certain mindset. And I have a friend in New York that I was with just now, and he comes from a very wealthy neighborhood, very wealthy family. So therefore, all of his friends, all of his dad's friends, come from very successful businesses. So he's a true believer in people. He's like, people do make it. Everyone I know is successful. So his frame is that. Then you have certain people that come from maybe a poor background. They've never seen anyone make it. So naturally, they're like, anyone that claims it is a fraud. So it really, truly depends on your environment. And I would actually put it out there to people, question your beliefs and question the beliefs that you believe the most, because that's where your limiting beliefs come from. But I want to get back to that point of, you mentioned at one point you didn't want to be online, you didn't want to do it. Now you've put effort in towards it, despite your huge trading credentials and your achievements. Why do you put yourself online? What do you gain out of it?
I think part of it was just wanting to be transparent with how hard it is to make it in this industry. Like, it's not easy at all whatsoever. Even if you have a really great mentor, whatever the case, you still have to put in the work, right? I had a really great mentor, but I would have been so much better off, I think, if I could have been able to ask people questions and I think be more open to conversation. I think that's where I've probably grown the most, is being okay talking with other people about trading, because when I was coming up, like, Zoom wasn't really a thing, and like the internet communication circle of trading wasn't as big as it is now. Like, I think the access to information that we have now, it's like the golden age. Because when I was learning how to trade in 2011, it was completely different. Like, it was much harder to make real connections because I was a skeptic. Like, this guy, I don't know this guy posting on the forum with his chart is actually making money or not. I was following it, but I think now it's been so great to be able to see other people online and be able to make that connection. Because now when I see other traders in person, it's almost like I already know them, because I've listened to their podcasts, I've heard about their story. I can resonate with pieces of the story, because at the end of the day, I'm always trying to improve and be a better trader. So I want to listen to some people that have different perspectives, because I do have a growth mindset. I'm not saying, this person doesn't know what he's doing, or I feel like I could always learn something from somebody, even if they are like the worst person in the world, right?
So I want to echo that. I think it's the best time to be a trader, despite certain hindrances, the wild west of prop firms and so forth. We have an abundance of information. I've said it a few times, and I think it's a great reflection to have, which is our quality of life right now. Even someone that's living a normal life, they have a better quality of life than the richest man on earth, just like 300 years ago, because we have smartphones, internet, electricity, a hot shower. Like, we have all these things. And I'm pretty sure the richest man on earth 1,000 years ago would swap with a regular person in today's day and age. Additionally to that, we have access to the best information. We can read books from the best traders on earth. We can watch videos and interviews of Elon Musk, like great pioneers and industry shakers, whereas literally 100 years ago, it was your neighborhood, and who you knew in that neighborhood would be your sphere. And I think it's wonderful that we can be a part of it and kind of share our experiences and try and build something cool out of it. Getting to the point of being a trader in this day and age, obviously you started like a decade ago, just over, and everything has changed. And even though there's an abundance of information, how would you navigate it with everything that is out there?
Like, if I were to start from the beginning?
Yeah, with the things you know now.
I would honestly probably give myself the same advice that somebody told me, was to like really just dial in and focus on the things that matter, and not try and get sucked into the rabbit hole, because it was the same back then. There was a rabbit hole of information, didn't know where to start, you didn't know what to focus on. Really, it comes down to like what is holding you back the most. Because for me, I think every trader is going to have a different, a different pain point that's holding them back. And if you can't change that, then you're never going to be able to make improvements. And that's kind of where you have to go from having the fixed mindset, thinking that I'm a bad trader, I can never figure this out, to having the growth mindset. It's like, well, and curiosity. It's like, well, I have this really bad issue that's holding me back. Well, how do I fix it now? Right? The curiosity is what's going to drive your improvement. So when you start questioning those things, it's like, these are all the pain points. How do I tackle them, essentially? And whether that's reading books, whether it's watching podcast videos, maybe the system or strategy that you're looking up doesn't resonate with you. It's all just trial and error. But when you're going through that trial and error period, really just try and narrow in and focus on a couple things at a time, right? Because there's key there's key concepts that you have to pick up in trading, right? It's the strategy or execution, psychology, the risk management, trade management. So those are all different facets that you have to pick up, and you can't try and pick them up all at once. It's like very, very hard to do. It's just your attention is being drawn in all these different areas. So I would say the fastest way to know is to get your feet wet, and even that's going to take some years, because you're not going to know if you're really bad at risk management until you're a year in.
Yeah. So on the show, I've had some phenomenal ICT traders, yourself and Casper, and even like Andrew NFX. He's a derivative, I think, of ICT SMC. I've also had some questionable characters that are ICT traders, and I could engage them. Regardless of that, I think the stamp of approval is there from people like yourself and the things that you have achieved. But I want to hear, in terms of ICT, seems like such a broad catalog of stuff, of concepts, and there are certain models you can have, but it seems like you've navigated yourself through all of that information well. So for someone that is new into ICT, which is majority of traders these days, how would you advise them to effectively navigate to get the most out of it?
See, that's hard for me to say, because I haven't watched his latest content, like the 2022, 2023, 2024 mentorships. So I can't tell what he's teaching in those. But I think you really have to break down all his different concepts and really just focus on a couple at a time, and not try and learn too many, because some people might want to try and learn breakers, but if you don't understand what a liquidity rate is and can't spot that, you're never going to be able to spot the breaker, because that's a piece of the puzzle, right? So a breaker is, you need a run on liquidity and then a market structure shift. But if you don't know what liquidity or market structure is, how do you determine what the breaker is, right? So I see some students that are pointing out breakers, and I'm like, that's not a breaker, because you don't have an impulse leg. So you have to understand that there's like prerequisites before you get to the more advanced concepts. People want to go straight to the advanced concepts when it's not really necessary. Focus on the simple things and perfect those first, right? Because then you can possibly refine with the more advanced concepts.
Now, moving forward, more than a decade in the game, kind of ticking off a lot of traders' dreams, which is you've traveled a lot, you've financially done a lot, you've built a brand, you've done a lot of cool things. But looking forward, what are you looking to achieve?
Honestly, looking to help more traders. So I just launched my education platform. It's been going really well, but obviously I think there's some areas that I can improve on and help traders in a better way. But I think the biggest thing is understanding each trader as their own person, right? And I've mentioned this to them. I'm like, I want to know more about you guys. So, if you guys want to drop a comment on this video, tell me about your story, whatever the case is, because I think that there's universal ways to improve, but specific ways that can apply to each trader depending on their position.
There we go. And now that you have kind of finally stepped into the educator role, I want to hear your thoughts kind of doing it after you had plenty of chance before, you've finally done it now. What kind of lessons you've picked up from being an educator for the small amount of time that you've had, and kind of key mindsets in people that are effective students?
Well, I think education in this space gets a bad rap first and foremost. Yeah. I think people really look at it and say, oh, this guy's a course reseller. This guy's a course reseller. Education has been recycled for decades, right? You're really picking somebody because you resonate with their values, and they have something to teach you, right? Beyond just a specific trading strategy. So I think some of the best students obviously make that connection with you as a mentor and are comfortable asking you questions, right, based on their struggles. So sharing your struggles as a teacher is going to, I guess, help you more align with the student and understand that all of the traders are struggling with the same things, like over trading, revenge trading, managing their emotions. It's very cyclical. Like every trader goes through the cycle. There's no way that you can avoid it. And I think the best mentors are just the ones that connect with their student and can help them fix those issues. And I put out this tweet that kind of went viral a little bit. I just mentioned, like, you don't have to be a great trader to be a great teacher. And I still stand by that fact, because the person that helped me the most outside of ICT was this guy in Canada. We were traders, but he gave me more life advice than trading advice. And I think that's where there's a disconnect in the trading space, is if you're getting life advice from your trading coach, that's like the best thing you could possibly get, right? And I think ICT resonates with so many people because when he hops on a Twitter space, it sounds like he's talking directly to you. But I would have probably got way more value if I could actually send him a message and be like, hey, this is what I'm going through. Obviously, he doesn't have the time for it, but that was one piece that I was lacking, that I had to reach out to somebody else. But then the credibility goes down. Like, because if ICT gave me a response versus this other guy that I don't know who he is, right?
You feel it more.
Yeah. But I think some of the best students, they just have an open mind, and they don't have a set limitation on how long this is going to take them, right? And they're disciplined. Right now, it's hard to say how many traders are actually disciplined out there. Like, you say you journal, but do you actually journal? Or you say you're going to stop after X amount of trades on the day. Do you actually do that? It's all really it comes down to self-control, because it doesn't matter how good your teacher is. Like, nobody's going to sit in the hot seat and make those decisions for you.
It goes back to what we mentioned earlier, of like the absolute winner mindset, or the winner's mindset. Is like, regardless of my environment, regardless of the mentor, I'm going to make it work. And I forgot who said it to me the other day. It was like, in even the worst community, even in the most scammiest community, you'll have winning traders. And even in the best community, with the best educator, you'll have unprofitable traders. Yeah. So sometimes it's not.
If you take everything out of the equation, at the end of the day, it's just you and a computer screen.
Yeah. Okay, so I want to kind of wrap up with, I like to see you as a very nice role model in the industry, because you have a very relatable background. You've went through the same struggles that a lot of people have, and you've come out the other side. You've maximized prop firms. You've navigated through all of the courses and information, and you've made it out the other side, built a personal brand. You've done everything that a lot of aspiring traders look to do. So I want to kind of hear your thoughts to them directly on what it is like on the other side. If they're going through the struggle right now, if they're losing hope, if they are, in the trenches, as someone who has made more than $1 million from the markets through prop firms, what does it feel like? What advice would you give to them?
So I would say, like, the epiphany moment that you think you might have, it's never really coming, because you're going to hit that specific level, and then you might go through a drawdown period, right? You might go, earlier this year I went through a drawdown period, and I kind of just took a step back and said, I'm burnt out from trading and being hyper-focused. Last year was great, right? And I really lent on that performance, but this year, not performing as well as I did last year, still pretty good, but just knowing that you're going to have ups and downs, regardless of whatever level you hit. Even if you hit $1 million in your trading, great, but just understand that that's a fleeting moment, right? That's just one data point in your entire journey, right? So when you hit that level, it's like, all right, well, what do I have to do to keep this up? And it really comes down to you being able to consistently show up to the markets, consistently do the same things over and over again. And then you just realize, like, all right, well, now I'm just back in this boring routine again.
So actually, the boys asked me this, my team, the other day, of like, what was it like when you hit your first million? And I gave an answer, but I want to kind of hear from you of, that day. Walk me through that day of, like, it's ticked over, finally, millionaire trader.
So I actually wasn't tracking the million, but I would say another big day that I had was a six-figure day. So my first six-figure day,
I remember it, yes.
was honestly just like any other day. It was honestly probably the same day that I had when I made $300, right? So when you're thinking about trading, just try to remove the numbers from the entire equation, because the money at the end of the day is great, yes, but the skill is really what's going to pay you. It's just, how do I scale that up, which is, I think, where I've been able to take advantage of the prop space, because it's so scalable. And again, it's just a high risk use of leverage. Right.
Kyle, bro, I've had so much fun. Thank you for blessing us with round 2. And maybe in 6 months, 1 year, we catch up again and see how life takes us. But bro, I just want to say this is so much fun to chop it up with you on a one-to-one this time, and explore everything technical related, trading related. Hopefully the viewers too had a lot of fun. Cheers,
Absolutely.
my man.
Cheers.
Boom.